Hello everyone, hope you are all doing fine. Today I'm going over the extra problems of chapters 2 and 3. I will start with the first problem where we have the financial statements for a given firm. We have the balance sheets for years 2015 and 2016 and the income statement for year 2016. Now based on those financial statements, we're going to compute the different components of the cash flow from assets. Then we're going to move to a financial ratio analysis. Now, through a quick look into those numbers, we cannot infer a lot of information from those values. We cannot tell a lot about, let's say, the financial situation of the firm and some of the variables of interest, let's say, for creditors, for stockholders, whether the firm has an efficient management team that's efficiently managing the firm's assets in order to generate revenues. However, we'll get more information once we compute the different financial ratios of the firm. So I'm gonna start with the cash flow from assets. And here you can see that you are asked to compute the different components, cash flow to creditors, to stockholders. This way, this is using that first approach. If I compute those two values, I can get the cash flow from assets. The second approach, I will need to compute the operating cash flow, the net capital spending, and the changes in net working capital. Now, of course, using either approach, I should get to that same answer to the cash flow from assets. Okay, I'll start now with the cash flow to creditors. The cash flow to creditors is equal to the interest expense. In this case, it's 1019 minus net new borrowing. Net new borrowing is mainly the change in long-term debt. So here, if I look to the long-term debt, I have 27,099 in year 2016 minus 22,352 in year 2015. This will give me minus 3,728. Now, the negative sign here means that creditors paid more in cash to the firm than they have received from that same firm. Creditors, they did get around $1 billion in interest, but in return, they've paid the firm more than $4 billion in a new debt because the firm raised new debt. And this can be seen from the increase in the long-term debt from around $22 billion to around $27 billion. Now, usually you may see here a negative number when the firm wants to finance some, let's say, new projects. So the cash flow from operations may not be enough to finance some new projects or new investments. In this case, the firm can rely on the creditors or the stockholders, and sometimes on both of them, it can at the same time issue more debt and issue more equity in order to finance those projects. Now, the cash flow to stockholders. This is equal to dividends, 1780, minus the change in the common stock. So minus 15,000 minus 14,868. And the answer here is 1648. So mainly the firm did raise some equity, but like it was much lower than the value of dividends paid to stockholders. The firm raised only 100, so the difference here, this is $132 million. So the new issued stocks, they had a value of $132 million. However, the corporation paid to its stockholders $1.78 billion in dividends. So the cash flow to stockholders is positive. Now I can compute the cash flow from assets. The cash flow from assets equals cash flow to creditors plus the cash flow to stockholders. And the answer is around minus $2 billion. Now remember, all the values here in the financial statements are in millions of dollars, so the value I'm getting is around minus $2 billion. So this is using that first approach. Now I move to the second approach. I start with the operating cash flow. Here I will have operating cash flow is equal to the operating income, earnings before interest and tax. I add any non-cash expense. In this case, I have in the income statement the depreciation, so plus depreciation. And then I deduct taxes. The operating income is 6,235. Depreciation is 1910. Tax is 1773. So the operating cash flow is $6,372 million. So this is the cash flow generated through the operations of the firm. Now the firm is gonna use part of this $6 billion and its new investments. However, as we're going to see, the firm will need much more than the $6 billion, and that's why the firm had to raise some new debt from its creditors, from its long-term creditors. The net capital spending, this is equal to the change in fixed assets plus depreciation. Here I have net fixed assets for year 2016, 59,700 minus 55,977 plus the depreciation 1910, and the answer is around $5.6 billion. Now for the last component, the change in net working capital. So this will tell me about the new investments of the firm, the new short-term investments of the firm in its net working capital. This is change in net working capital. This is equal to the net working capital in year 2016 minus the net working capital in year 2015. The net working capital in year 2016, current assets in year 2016, so I have here 34,301 minus current liabilities in the same year, 6,370 minus the net working capital in year 2015 is equal to current assets in 2016, 31,222 minus 6,110, and the answer here is $2.8 billion. Now to compute the cash flow from assets, cash flow from assets equals operating cash flow, which is 6,372, minus the net capital spending, 5,633, minus the change in net working capital, 2,819, and here I'm getting minus $2 billion. So although the firm did generate through its operation around $6 billion in cash, the new investments in fixed assets and in the net working capital totaled more than $8 billion. That's why the firm had to get a net of $2 billion from its creditors and its stockholders. Okay, now I move to the financial ratio analysis. I'm going to compute all of the financial ratios that we've covered. I will cover first the short-term solvency ratios or the liquidity ratios, the current ratio, the quick ratio, and the cash ratio, before moving to the long-term solvency ratios, which include the total debt ratio, debt to equity, equity multiplier times interest earned, and cash coverage. Now, starting with the current ratio, the current ratio equals current assets divided by current liabilities. Here I'm going to compute all of the ratios for year 2016. Current assets in year 2016, I have 34,301 divided by current liabilities of 6,370. The answer is 5.38 times. This means for every $1 in short-term obligation, we have $5.38 in current assets. So this is quite a good coverage. It's even like from the perspective of short-term creditors, this is a very good number, because if you remember, we've said that this number should be greater than 1. Whenever that number is less than 1, this means that the firm is more likely to face some financial difficulties in meeting its short-term obligations. That's not the case here. For every $1 in short-term debt is covered by $5.38 in current assets. However, that number from the perspective of stockholders shouldn't be that high, because a high current ratio implies that the firm is investing too much in current assets. Investing too much in current assets will lead to a lower return on equity, because usually the more liquid the asset, the lower the return of that asset. And mainly most of the return for the firm is generated from investments in its fixed assets, from its long-term investments. Now, after the current ratio, I will compute the quick ratio. So the quick ratio is similar to the current ratio. However, here I remove the least liquid component of current assets. So mainly I'm going to remove inventory. So I'll have 34,301 minus 16,817 divided by 6,370. The answer is 2.74 times. So even without our inventory, each $1 in short-term obligations is covered by $2.74 in current assets without including the inventory. Finally, the cash ratio is equal to cash divided by current liabilities, 7,113 divided by 6,370, and the answer here is 1.12 times. So every $1 in short-term obligations, every $1 that we need to pay over the upcoming 12 months is already covered by $1.12 in cash. That number is very good for a short-term creditor, because that the creditor knows, or the supplier knows, that the firm won't face any difficulties in paying those short-term obligations. However, as I said, from the investor's point of view, that's a very high number. It means that the corporation is keeping too much in cash. It's keeping $7 billion that are earning virtually like a 0% return, or a very low return. So now, to conclude with those ratios for the supplier, from a supplier's point of view, those numbers are pretty solid. They are very good numbers. From my point of view of investors in that firm, those are not good numbers. And as we're going to see later on, once we compute the profitability ratios, those ratios keeping too much invested in current assets will have some negative implications on the return on equity, as we're going to discover later. Okay, now for the long-term solvency ratios. So those ratios can be divided into two components. The first component has to do with the capital structure of the firm, the mix between debt and equity. The second component has to do with the ability of the firm in meeting its interest expense. I start with the debt or total debt ratio. So debt ratio is equal to total debt divided by total assets, or to total assets minus total equity divided by total equity. Total liabilities 33,469 divided by 94,001, and the answer here is 0.36. So I can say that the capital structure of the firm is 36% debt, 64% equity. Or I can say it in the following way: every $1 in assets is financed through 36 cents in debt and 64 cents in equity. Now the second ratio, the debt to equity ratio. So this is total debt divided by total equity, 33,469 divided by 60,532, and the answer is 0.55. Then I have the equity multiplier. The equity multiplier equals total assets divided by total equity. which is equal to total debt plus total equity divided by total equity. So the equity multiplier is equal to the debt to equity ratio plus 1. So 0.55 plus 1, the answer is 1.55. So now I can also represent the balance sheet in that format. Instead of saying that I have 36% debt, 64% equity, or 36 cents debt, 64 cents in equity for every $1 in assets, I can say that for every $1 in equity, I'm raising 55 cents in debt, and that will allow me to acquire assets with a value of 1.55. And that's the equity multiplier. It means that for every $1 in equity, I have $1.55 in assets. And the equity multiplier, this tells me about the leverage, the level of leverage in the firm, and this is one of the three major components of the return on equity based on the DuPont identity. Now, by the way, if I want to talk about those ratios really quick, the average non-financial firm in the US has around 50% debt. The capital structure is 50% debt, 50% equity. So I can say that the level of leverage in that firm is lower than the average non-financial firm. So to a certain extent, those numbers are good for long-term creditors or to bond holders because the firm is not relying too much on debt. There's nothing alarming about the level of debt in that firm. Now I compute times interest earned, which is equal to the interest expense. The interest expense is 1019. Excuse me. So here I have the operating income 6,235 divided by the interest expense, and the answer is 6.12 times. So for every $1 in interest, the firm is generating $6.12 in operating income. Now, the higher that number, the better. Because the higher the number, this will imply that the firm is easily able to meet its interest expense, its annual or quarterly interest expense. Now, a more accurate ratio is the cash coverage ratio. So with this ratio, I add to the operating income the non-cash expense, in this case depreciation. So I will have 6,235 plus 1910 divided by 1019, and the answer in this case is 7.99 times. So that's it for the second category of financial ratios. Now I move to the management efficiency ratios. So here I'll go over 5 different ratios: inventory turnover, days sales and inventory, receivables turnover, days sales and receivables, and the total asset turnover, which is the most important ratio of that category. I start first with the inventory turnover. that ratio is equal to the cost of goods sold, which is 6,084, divided by inventory 16,817. As I said before, like the more accurate ratio is when, like whenever you have one value from the income statement and one value from the balance sheet, it's better to take the average of years 2015, 2016, because the income statement for year 2016 is true over the period from 2015 till 2016. But like here, for simplicity, we are using the end of year values. Inventory turnover equals 0.36 times. Inventory turnover tells me how many times in a year is the firm able to turn over all of its inventory, to sell all of its inventory. In this case, it's 0.36 times within a year. So the firm is only able to sell 36% of its inventory in a 1 year period. That number here is very low. Now, days sales and inventory, this ratio is equal to the number of days in a year, 365, divided by the inventory turnover, divided by 0.36. The answer is 1009 days. Now, of course, when I have here a very low number, this means here I will have a very high number. So on average, it takes the firm more than 1,000 days to sell all of its inventory. And that's a very negative number. That's a very negative signal about the firm ability to sell its inventory and generate revenues. Now, receivables turnover. Receivables turnover is equal to sales divided by receivables in 2016, accounts receivable, 10,371. The answer here is 1.37 times. So the firm collects the receivables from its customers 1.37 times within a year. Now, for this ratio here, we are making an assumption that $14 billion in sales is mainly credit sales. Of course, if I have more information like how much in cash sales and how much in credit sales, the amount that I should include here is that of credit sales. But like mainly if I have only the balance sheet and the income statement, I do not have the breakdown between cash sales and the credit sales, so I will assume that all that amount in sales is for credit sales. Now I can compute days sales and receivables. This is equal to 365 days divided by 1.37 times the receivables turnover. The answer here is 266 days. That number here is too high. So it means that it takes the firm around 9 months to collect its receivables from the customers. So not only the firm is not able to have a high sales volume based on the level of inventory, even when the firm is selling to its customers, it's taking the firm too much time to collect cash from its customers. So there are definitely issues with the collection process within the firm. Now, the final ratio that I'm going to compute within this category, the total assets turnover, is equal to sales 14,229 divided by total assets 94,001, and the answer now is 0.15 times. That's a very low number. There's a huge issue here. So we are making an investment of $94 billion in assets to generate only $14 billion in sales. For every $1 invested in assets, we are generating only 15 cents in sales. And here you can see that there are major issues with the managerial team in this corporation. So although that corporation has a very low total assets turnover, the corporation did make new investments of more than $8 billion in fixed assets and in short-term investments. And mainly, you have to make such investments if you are able to generate high volume of sales and high net income. So in that case, there's no reason for those new investments given that very low total assets turnover. Now I move to the fourth and fifth categories. I'm gonna compute the profitability ratios, the profit margin, return on assets, return on equity, and then the market value ratios, the price to earnings ratio, and the market to book ratio. I start with the profit margin. The profit margin equals net income divided by sales, 14,229. The answer is 24.2%. So for every $100 in sales, the corporation is generating $24.2 in net income, and that value is a decent value. Now, return on assets equals net income divided by total assets, 94,001, 3.67%. That's a very low value. Return on equity, net income divided by total equity. The answer here is 5.69%. And now, if I want to do that breakdown of the return on equity equals the profit margin, 24.2%, times the total assets turnover, 0.15, times the equity multiplier, 1.55. So here, if I want to see what's the reason behind that low return on equity, the main issue is here with the total assets turnover. Because as you can see, like the return on equity here is a high, the profit margin, is a high profit margin of 24%, 1.55. This is below the average, but like that's not the driver behind that low return on equity. The major issue is here with the total assets turnover. if you are a financial analyst, maybe one of the recommendations that you may give to the firm is to lower its prices, to lower its profit margin. So I may lower that value here in order to increase my sales volume and consequently increase my total assets turnover. Now for the last category, I start with the price to earnings ratio. The price to earnings ratio equals the price per share divided by the earnings per share. Earnings per share equals net income 3,443 divided by the total number of shares 5,000, and here I can directly divide 3,443 by the 5,000 because all the figures, whether in the balance sheet or the number of shares outstanding, they are in millions. So here in millions of dollars, here in million of shares, and the answer here $0.6886. So PE equals the price 75 divided by 0.6886. The answer is 108.92. That's a very high price to earnings ratio. You may see, like, let's say a growth company, let's say a company in the technology sector with a high price to earnings ratio. But such a ratio should be supported with a very high return on equity, which is not the case. Here, the firm is only generating 5.69% as a return on equity. So this implies here that the stock of this firm is overpriced. And as a recommendation, if you are giving a recommendation to an investor in that firm, you will tell that investor, although that corporation is performing poorly, the stock price of that corporation is relatively very high. So the best thing that you can do is to buy all of your shares and cash in the price of $75 per share. Now, the market to book ratio equals the price, the market price, divided by the book value per share. So this is equal to $75. The book value per share is equal to total equity divided by the number of shares outstanding. So this is 60,532 divided by 5,000, and the answer is 6.2 times. And this ratio is similar to the price to earnings ratio. The higher the value of the price to earnings ratio or of the market to book ratio, this may imply that the stock of a corporation is overpriced. So that's it for the first problem. Now I move to problem number 2. So here Boyer Enterprises had $200,000 in taxable income. What's the firm's average tax rate based on the rates shown in the following table? So now what I'm gonna do is the following. Determine where that taxable income is within which tax bracket. It's within that tax bracket between 100,000 and 335,000. So for the first three tax brackets, I'm gonna take the full tax bracket. So for that first tax bracket here, this is the upper limit 50,000 minus the lower limit minus 0. So here I have 50,000. I multiply the tax rate by that full tax bracket, 15% times 50,000, 7,500. Then for the second tax bracket, it's 75 minus 50,000, it's 25,000 times 25%. The answer is 6250. For the third tax bracket, it's 100,000 minus 75,000, 25,000. I multiply it by 34%. So it's 8,500. Now for the fourth tax bracket, we are already in that tax bracket. So I do not take the full tax bracket. So instead of taking the upper limit minus the lower limit, I take the taxable income 200,000 minus the lower limit, which is 100,000. So here I have 100,000, which is 200 minus 100 times 39%. So $39,000. I add everything. I get 61,250. So my average tax rate is equal to 61,250 divided by 200,000, my taxable income, and the answer is 30.625%. If the question was about the marginal tax rate, the answer is 39%. So this is the tax rate of your current bracket. Because if this firm generates one additional dollar in taxable income, that dollar is gonna be taxed at a rate of 39%. Okay, number 3, Lancaster Toys has a profit margin of 7.5%, total assets turnover of 1.71, and a return on equity of 21.01%. I need to find the debt to equity ratio. Now, the debt to equity ratio equals total debt divided by total equity. I do not have any information here about total debt and total equity. However, based on the information that I have here, I have the return on equity and two of its components. The last component is the equity multiplier. So based on those three values here, I can compute the equity multiplier. Once I have the equity multiplier, I can easily find the debt to equity ratio. So here I can say return on equity equals profit margin times total assets turnover times equity multiplier. So the equity multiplier equals the return on equity 0.2101 divided by 0.075 times 1.71. So the equity multiplier is 1.638. Now the equity multiplier equals debt to equity ratio plus 1. This means debt to equity ratio equals equity multiplier minus 1. And the answer here is 0.638. Now for the last problem 4, I have debt to equity ratio of 2.05, return on assets is 9.2%, and total equity is $560,000. I need to find the net income. Now, based on the information that I have the return on assets. Return on assets equals net income divided by total assets. Here, I need to find net income and I do not have total assets. So here, as I have the return on assets and I have the debt to equity ratio, I can compute the return on equity. Because mainly the return on equity equals the return on assets times the equity multiplier. The return on assets is 9.2% times the equity multiplier is 1 plus the debt to equity ratio. So 1 plus 2.05. The return on equity is 28.06%. Return on equity equals net income divided by total equity. So net income equals return on assets 0.2806 times total equity 560,000. So the answer is 157,136.